So, welcome everyone to the seventh community of practice. We are now entering into I can say, like the final month of the Soteria project, and the community of practice, an important opportunity to present the work and the progress that has been carried out in this project. Today, we are lucky we're going to have two presentations. So the first one will be delivered by Marina Lehmann from, I cannot say the German name, but if I translate in English, I think it's the University of Applied Science in
Yeah,
Bavaria.
yeah.
So she will present the key output and takeaways of the deliverable 3.4 on policy recommendation on sustainable insurance principle, which was submitted in October this year. And then the second presentation will be delivered by Maria de Vries from Genera and Co. So she will present also the output of the deliverable 3.7 on guidance on insurance pricing, product and services, best practice in emerging insurance solution, which is normally delivered in this submission in December 25. Each presentation will last around 20 minutes, and we will have time for question after each presentation. So we are not a lot today, so if we will have enough space for it to ask question after the presentation. Thank you all very much for joining us today, and also special thanks to Maria and Marina for presenting their work.
So my name is Marina Lehmann, and I'm in the project. I'll do it for Barbara, who's on maternal leave. Today, I would like to talk about the policy recommendations on sustainable insurance principles and rules. And first, I will provide an overview of the political landscape and discuss weaknesses and possible improvements, which was an essential part of deliverable D3.4. And then I will briefly outline the status quo of sustainable insurance in the insurance industry. So let's get started. So before delving deeper into the world of sustainable insurance, I first ask myself, why do we need a new insurance concept? I'm sure you all know it, but just to remember, after all, as the saying goes, never change a running system, but that's exactly the point. The system no longer works as it did in the past. Because in light of accelerating climate change, environmental degradation, and social and economic uncertainties, the insurance industry must fundamentally rethink its role. For now on, sustainable development is indispensable in the insurance industry. And the concept of sustainable insurance makes an important contribution here, as it supports a whole range of the sustainable development goals. I have here some pictures which show the sustainable development goals which are contributed by sustainable insurance. For example, sustainable insurance supports goal number 1, no poverty, as it provides a safety net for those using it and prevents families from falling into or returning to poverty after a stroke of misfortune. And if you are interested in reading more about how sustainable insurance contributes to the Sustainable Development Goals, I can provide you a report of the Deutsche Gesellschaft für internationale Zusammenarbeit, and I also have more examples in the report. So there is definitely a need for sustainable insurance, but what exactly is the concept about? What lies behind the term sustainable insurance? For the practical implementation, it is essential to clarify these questions. And unfortunately, this is easier said than done, as there is currently no uniform, generally accepted definition of SI. During my research, I found this definition. It's the best known definition of sustainable insurance developed by the UN and is called the UN Principles for Sustainable Insurance. And the principles state that I do not want to read the whole thing what's here on the slide. You can read it on your own. But the definition shows that the integration of environmental, social, and governmental issues is a main part of sustainable insurance. And this is what leads us to the next big question. How can we implement sustainable insurance practice? Well, the effective implementation of sustainable insurance practices requires standardized rules, definitions, and reporting mechanisms. And there are already a number of key frameworks that provide guidance on ESG integration and the classification of environmentally sustainable activities. For example, one of the most common frameworks are the principles for sustainable insurance, as already mentioned, of the United Nations. The UN Principles for Sustainable Insurance are a global framework developed under the UN Environment Programme Finance Initiative. And the principles help the insurance industry to integrate environmental, social, and governance factors into core business activities. And the overall goal of the PSI is to enable insurers to better manage sustainability related risks and opportunities and to contribute to a more sustainable economy and society. As I already mentioned, the PSI provide a definition of sustainable insurance. Further, it contains four core principles. Firstly, insurance companies that apply the principles have to integrate ESG issues into their decision making along the entire value chain and their core businesses. Secondly, they have to engage with their clients and partners to raise awareness, manage risk, and develop solutions. Thirdly, they have to promote public awareness and action on ESG issues by cooperation with governments and other regulators. And fourthly, they have to demonstrate accountability and transparency regarding the company's progress in implementing the PSI. Here is another framework, the Principles for Responsible Investment, which are a UN-supported initiative that helps investors incorporate environmental, social, and governance factors into investment decision-making and ownership practices. And their goal is to improve long-term risk management and returns while contributing to a more sustainable global financial system. These principles were not developed specifically for insurance companies, but as insurance companies are important investors in the financial market, the principles support the concept of sustainable insurance. And there are 6 principles provided by the Principles for Responsible Investment. The principles say, for example, that the company incorporates the principles will incorporate ESG issues into investment analysis and decision-making processes. It shows ESG is a very important part here, as it is also mentioned before. And the participation is voluntary, but signatories are expected to actively implement and report on the principles. And these principles provide broad principles for responsible investment. Another framework is the EU taxonomy for sustainable activities, which is a common classification system of the European Union that defines which economic activities are considered environmentally sustainable. The taxonomy does not define what is forbidden, but only what qualifies as sustainable. And it forms the foundation for other EU regulations, such as the Corporate Sustainability Reporting Directive or the Sustainable Finance Disclosure Regulation. And further, it defines detailed technical thresholds and performance requirements like emission limits and energy efficiency standards. And it creates a common language for sustainability. In contrast to the PSI, the taxonomy does not provide a definition, but it defines economic activities considered as environmentally sustainable. The taxonomy states that an economic activity can only qualify as taxonomy aligned if it contributes sustainably to at least one of the 6 defined environmental objectives, and if all 4 core criteria of the EU taxonomy are met. One of the core criteria of the EU taxonomy is, for example, compliance with fundamental social and governance standards. Here I tried to state briefly the main topics of all the 3 frameworks that I presented to you, and you can see it as a comparison of the 3, and I don't want to go into every single aspect, but I would like to highlight at least a few important points. And as you can see, for example, both the PRI and the PSI are voluntary, whereas the EU taxonomy is legally binding under EU law. And further, the 3 frameworks have different focuses, answer different key questions, and scope different ESG issues. The implementation of sustainable insurance not only needs frameworks, but also reporting standards, which disclose the implementation progress of sustainability in insurance companies. And here the task force on climate-related financial disclosures was established. It was established by the Financial Stability Board to develop consistent, comparable, and decision-useful disclosures on climate-related financial risks and opportunities. And the recommendations provide a standardized approach to disclosure climate-related information, which is essential for transparency in sustainable insurance. The recommendations allow companies to demonstrate their commitment to manage climate-related risks and opportunities and to provide consistent and comparable information to. And the reporting recommendations address 4 key areas. First, governance. Here it addresses the question, how does the organization's governance address climate-related issues? The second is strategy. How do climate risks and opportunities affect? In terms of risk management, it should answer the question, how are climate-related risks identified, assessed, managed, and integrated into the overall risk management of an insurance company? And metrics and targets. Here the company has to disclose what metrics are used to assess climate risk and opportunities. And it's important to say that the TZFD focuses primarily on climate-related disclosures and not on social or governance-related issues. Another reporting standard is provided by the MSCI. This is the Morgan Stanley Capital International, and they developed ESG ratings that are based on 3 main pillars: environmental, social, and governance-related pillars. And the 3 pillars are crucial for assessing an insurance company's sustainability and ethical performance. Insurers that use these metrics can more effectively evaluate potential risks, develop products that promote sustainable development, and encourage responsible business practice. The findings show that current regulatory efforts provide a solid foundation, and numerous policy frameworks and reporting standards already guide insurers in developing, implementing, and disclosing sustainable practices. But however, significant gaps remain. Despite limited progress on legally binding, widely applicable frameworks, the sector still lacks common standards for metrics, reporting, accountability, and practical implementation. And the status quo does not reflect the diversity of the insurance landscapes in terms of customers, clients, size, legal form, etc. And amid all the discussions about sustainability, we must not forget that economic efficiency is the basis for the existence of every company. Based on our findings, we have the following recommendations for policymaking. First of all, regulators should establish and support sustainable insurance standards and certification schemes that promote consistency, reliability, and trust. And these standards should enable investors and policyholders to compare insurers and their products in terms of sustainability, while also taking into account the sector's heterogeneity, including differences in company size, customer base, legal form, turnover, and key metrics. And in addition, regulators should encourage the sharing of loss data among insurers and other stakeholders to improve risk assessment and support the development of tailored SI products. Finally, they should define clear levels of sustainability to guide both the development and the evaluation of SI products. So far, I talked a lot about the why, what, and how of sustainable insurance, but what about the who? Who implements all the frameworks and standards? So let's conclude by taking a look at insurance companies, or rather the practitioner, when it comes to sustainable insurance. Insurance companies influence sustainability through 2 primary channels. First, as major investors, and secondly, as providers of insurance solutions. And through responsible investment, for example, insurers can direct capital towards sustainable infrastructure and renewable energy, and also withdraw investment from industries which are inconsistent with its sustainability goals, for example, fossil fuels as coal. By offering innovative products, insurers can help clients to adapt to environmental and social challenges, for example, policies for electric vehicles and eco-friendly buildings, or special policies for disadvantaged people or people with chronic illnesses. Despite all efforts, sustainable insurance companies are still struggling with problems. On this slide, I have summarized the main obstacles and challenges for insurers in implementing the concept of sustainable insurance. For example, there is a lack of comprehensive models, indicators, standardized tools, and data sharing mechanisms, which limits the insurer's ability to measure and monitor sustainability impacts and build robust SI strategies. The different frameworks are competing, the principles are inconsistent, and the market maturity also varies, which complicates the alignment across the sector. And limited regulatory guidance, inconsistent expectations, and gaps in available climate and nature-related data slow the implementation overall. The varying market readiness and unclear implementation pathways also hinder the progress. And last but not least, there are too few public-private partnerships that exist to expand the coverage for ES risks and strengthen resilience. Based on this findings, we made the following recommendations for insurers. First of all, trusted certificates have to be developed and implemented, and they must base on the MRV, which stands for Measurement, Reporting and Verification, certification schemes for transparency and credibility. And it is very important that SI products include clear risk mitigation and adaptation measures. Insurance companies should also focus on essential sustainability requirements first for gradual manageable improvements. And SI products should be kept straightforward to encourage adoption. Existing frameworks should be used by the insurance companies, and ESG criteria should be implemented to streamline development. And it's also necessary to promote existing initiatives of public-private partnerships in order to inspire similar efforts. This was so my key message I want to take from the report, that it's time to establish a uniform definition, a legally binding framework, and a uniform reporting standard that take into account the different types and needs of insurance companies and other stakeholders. So this was the official from my side. Thank you for your attention. I hope it was not too fast.
Thank you very much, Marina. Do you have questions? We can take one or two questions.
I have a question, of course, if I can. But thank you, Marina. It was for me very good to get this overview. I don't remember everything, but already. But I have a question about your recommendations for the policy for policymakers. Is there? I didn't see a recommendation to make it, compulsory or to implement. I mean, I think the reporting is compulsory, right? But not implementation. Is that correct?
What do you mean by this?
So
you mean how the policymakers can support the implementation of the insurers?
Yeah, how they can, I mean, if I understand correctly, they have to report from the EU taxonomy. They have to report on their sustainability what they do on sustainability, but it's not necessary for them to fulfill certain requirements. I mean, they don't have to implement yet, or is it?
The problem is that there is nothing that is really legally binding.
Yeah, okay. Not even the reporting.
Well, the companies have to report, but it's very, how can I tell it? Every company has to make a sustainability report, I think, most of all. And for insurance companies, it's the same. And I read a lot of these reports from insurance companies, and in my opinion, or what I find out during the investigation, you cannot compare really the reports from different companies, and so if you read them, you cannot say, okay, this is a really sustainable insurance company and this is not. It's not so specified.
Yeah.
I think that's the problem. There should be really targets. You should offer products in this area, and they should cover this and this, and it's not yet in the frameworks.
So okay, besides these targets, and indeed that there's uniform reporting, do you not think that policymakers should also set targets?
I think they should set targets.
Can I just ask a kind of similar question or more reflection? In Norway, to all the insurance companies, they have these concessions to do what they do. and that they get from the government. Doesn't that mean that the government can, when you give a concession, then you also could you work, or it's more a question to you, which is deep into this, could they put some requirements into this, or could you, what you say, more or less force it into this in that direction? You said something about these public-private partnerships, way of working or products, and do you understand what I mean?
You mean if the policymakers can not only make policies, but step in public-private partnerships to encourage implementation?
At least I just know the Norwegian way, and then to run an insurance company, you have to get I mean, the English word is we call it concession, but I think the English word is concession. At least you have to apply to be able to run an insurance company. So, and of course, then there are some requirements which you have to fulfill. So in Norway, for example, you have to give all buildings an insurance. But of course, it will be very, very expensive for those which is located in a very risky place. But
I don't know if this is the same in Germany. I don't think that you have to give a policy to all buildings. I don't think so, because we have I know we had a catastrophic flood a few years ago, and I know that there are houses in areas which are critical to floods and which have a high risk to be flooded. And there you cannot insure your house. It's not possible. Not with a normal insurance company. I don't know, Maria, am I right? But this is my information.
Yes, as far as I know, it is correct. Yeah.
Okay. So there are obviously national differences there. So, So,
yes, Maria Jose.
Yeah, thank you very much. This is a very extensive and useful presentation. Thank you a lot. I concur with the comments that the insurance systems are quite different across countries in Europe. That also makes me thinking that perhaps the recommendations for policy making should be also adapted to the actual differences that, or at least the main differences, no? I mean, and they are also different challenges. For example, in Spain, the system is a solidarity system. So the challenges from a system that is based on primes is different. So do you think it would be possible to go a little bit more in depth on the policy recommendations to, at least on general terms, provide some priorities for different systems in Europe? Is this something that could be considered? I'm not saying maybe in this project, but a recommendation that could be general also, that those policymakers who have to think on the differences and also establish some priorities, because for example, encourage sharing of lost data, right? We have now the fact that most of the public administrations are collecting lost data in much better ways than before. We know that the insurance companies are collecting those data based on actually the insured assets. But there is a gap because they don't have data on non-insured. Can we go a little bit more in this recommendation, for example, a little bit beyond that? For example, indicating that it's not only about sharing those data among insurance and stakeholders, it's also about actually making those data consistent, harmonizing them, and be used by both sides, by the business side and by public side, because at the very end, what you need is actually reducing the risk through adaptation measures that have a large component on public sources, but also private sector, for example, companies are also thinking now on resiliency when they are developing a new business, no? and the insurance companies have a role there too. So I wonder if you think that because I think this will be very interesting also for the super deliverable of the project to go a little bit deeper on those aspects and tailor a bit more to different circumstances. Sorry for being so long in my question.
You're absolutely right, and I think this should be definitely taken into account. And if the project would be last longer or something like that, we definitely should go there more in detail and look at different countries, and then within the country also differentiate regions or something like that. Yeah, because this is not so in detail. We didn't differentiate between different countries. We just had a look at which frameworks are here. And for example, on the EU level, we have the taxonomy, but all the others, the other both, the PSI and PRI are on global level. So they should cover, for example, Norway as well as China or Australia. And I think there we really have differences, and the principles are too common. I think that there have to be principles and frameworks which go definitely deeper into the challenges of the different countries and their needs. Answer this your question or not?
Yeah, it answers my question. Also links to a follow-up of the question, which is we cannot implement all these recommendations probably at the same time. So
No.
probably it's good
No.
to provide also a sequence of the priorities to move.
Yeah.
So yeah, and that probably even with the level of detail you have here, it can be suggested, no? What are the main priorities or sequence? That will be also very useful.
Yeah, I agree with you absolutely.
Maria, and then I think we should start your presentation.
Yeah, I thought that maybe this was also, I mean, this to go into the regions and the data requirements, and maybe isn't that also covered a bit by the work done in the work package 2 or on the task 2. I don't remember the data task in work package 1.
There should be a work package with the data. Yeah, I think so. Yeah.
I mean, I don't know if they have policy recommendations as well, but maybe it could be combined.
I think on the work package 2 they focus a lot on the data actually. So on one of the aspects which is highlighted here. On work package 4, there has been this analysis of the different countries with the case studies. So probably sitting together and maybe we can extract some more in depth on the areas that have been covered in work package 4 and work package or at least in work 4.2 and 2. I think there are very good recommendations on data by work package 2. It illustrates also that probably the data is also a priority because data is fundamental for making decisions at the moment, even if it's not the standard, right? So maybe we can work together across work package 2, work package 4, and help on maybe introducing some either general introduction for that will require a prioritization on how to implement the recommendations, and that also indicating that we are being deepened much more on certain areas, much less, for example, on areas related to standards and certification, which is extremely technical for actually the business itself. So maybe we can also enrich a little bit in the policy brief. If we do a policy brief, we can enrich.
Okay, thank you. I think you can go to the Maria, your presentation.
What I will talk about is the intended content of our deliverable 3.7, which is a bit behind schedule. It's ongoing work still, but explain what is going to be in there and what we finished already. So on the guidance on implementing best practice insurance solutions for climate change adaptation. Just a short introduction on how this guidance has been based on like an ideal risk management process. Here is a nice picture of that from a EU report on insurance and risk management tools in agriculture. Ideal risk management is indeed about first risk identification and the need to analyze and gather a lot of good risk data and analyze it to identify the risk and assess the threats. I think that in this picture, risk avoidance is missing, but as it does not have too much to do with insurance or less relevant for insurance, the risk reduction is an important second step. So how can insurance solutions help in risk reduction? And then it's about risk layering. So once you know the risk and you can reduce the risk. If you can reduce the risk, then it's about who carries the risk and how can you implement solidarity principles, so sharing the risk. So there are some who are retaining a share part of the risk, the ones that have the risk, well, actually the risk carriers, and the part that they cannot retain should be transferred. And we'll go to this risk sharing principle next. And then there is a residual risk that is then always remaining. Well, not always, but there is always, I think there's always a residual risk. This risk sharing principle is based on this risk layering approach, depending on the frequency and severity of the hazard that is in focus. So where high frequency and low severity risks carried by the risk carriers, and here in this case farmers, they retain a part of what they can financially, burden themselves with. Then there is the risk transfer to the private sector, for example, insurance industry. But they also suffer from a limited capacity, so they cannot take on all the risk that private people can take, because it is in generally it's just too expensive. The risk is too high. So there is a part of the risk that you could say that the public sector needs to assume in a way of a solidarity mechanism. There's always from low frequency but high severity risks, that is, no? So low probability but with a high impact. And there is also always the residual risk. We think, for example, about the corona, which is not, a good example of how national and multinational relief programs carry part of that. I have made here an overview of insurance solutions supporting climate change adaptation. So there are four pillars, as also established by Alexander and who have set our partner in work package 3. So you can categorize them a bit in business model types, solutions, product and pricing solutions, and new technologies or data models, as well as shared resilience solutions. I won't go also into all the small points here, but business models can focus on preventing, because preventing is actually a very economically attractive thing to do. The return is quite high in the damage, and the cost for preventing there's a high return in risk, damage reduction. But there are also a business model in increasing the services of the insurance company. For example, providing climate risk information to their clients, or financial support for adaptation measures. There could be cooperation that, for example, with banks, input providers in the case of agriculture, or technology providers, and other financial or maybe other business models, more like microinsurance or resilience. In the product and pricing sector, pillar, there's affordability improving measures, innovations. It can be done cost reduction of the company of the value chain, implementing a premium reduction because the client implements risk reduction measures. The attractivity of the products. There's been a lot about behavioral approach, different solutions there. Product, there's many potential. There's a high potential there to see how the demand can be met better. Contact point improvement and better explanation of products and increasing the product palette. So yeah, but there are also multiple ideas. So some of them also increasing affordability. New technologies and data models. So there's high potential to use more client data or incorporate more open data and more data analysis methods or new data analysis methods to improve the risk analysis and improve the data gathering infrastructure, for example, measurement devices. Then the shared resilience mainly is based on solutions as cooperating with the state. So sharing loss data or share the actual risk we talked about before. How can the government take or support the risk sharing or take a part of the risk itself? So here are some benefits from each pillar. So extra income streams for the insurance company, increasing client happiness, or reduce the damage from the hazard. Benefits from product and pricing solutions, increasing affordability of the value of for example, value of natural areas, and sustainability, better client contact and demand awareness. The benefits from incorporating new technologies and data models, so more price differentiation and high affordability for lower risk clients. So the better you know what the risk is in which location, the better the lesser the insecurity and the higher affordability for lower risk clients. Of course, the higher risk clients will not have a more affordable product. But it can also improve the warning services and risk modeling and reduce the basis risk and increase the scale of it. The benefit of shared resilience solutions is a transparent risk layering, improves the shared risk view and what everybody can carry, increase the motivation for adaptation. If you know that there is I want to go into 3 more concrete solutions and talk about their barriers and enablers. I hope I have enough time. Definition of want to first talk about resilience bonds, which is a financial instrument that combines catastrophe bonds with resilient investments. So where a normal bond just the premium flows from the risk carrier to the financiers. But in the resilience bond, a part of this premium is used for risk reduction measures investment. So the benefits are that it encourages investment in risk reduction infrastructure while providing financial protection. There are some examples for New York City's resilience bonds for financial coastal protection measures. Increasing barriers for this solution is, well, first of all, it's quite new, but the barriers for climate change often is that the risk is actually increasing. So payouts are triggered, which is leading to a lower interest for this. Enablers are clear risk reduction measures that have a clear reduction, so that the resilience bonds are more attractive. And of course, ESG principles and reporting guidelines, this EU taxonomy, what Marina, you just talked about. It's a enabler or a motivator for this. Another solution goes more into the public-private partnerships, the risk sharing, and the definition is a collaboration between the governments and insurers and development agencies to cooperate and improve the risk sharing. So there is the example of the insurance premium subsidies by the state. These are often non-conditional, so there's everybody who buys insurance can get it, but there is also the option to do a conditional or prioritized subsidy depending on how risk prone the risk carriers are, or the state provides reinsurance to an insurance. The state can guarantee a fund or a compensation for high severity risk layer, and the state buys reinsurance for high severity risk layer, or the state buys insurance actually. They could take over a part of the risk for the high risk individuals. The benefits of such a model is that it leverages public funds to share the risk with the at-risk population, reduces the risk, and increase the insurance affordability and enable the private sector investments. And examples are the French and the Spanish system for agriculture. There are quite some barriers still here. So there's risk data availability is a key problem for getting everyone involved, and the modeling expertise, political instability, and maybe a willingness, and actually quite some competition as well. I think internally in the government can create a barrier here as well. Market competition and behavioral barriers. I mean, there are still quite some non-financial barriers that limit the take-up of insurance. It's not very specific for the public-private models, but it can be mentioned here. Simplifying administration and improving information, which also addresses these behavioral barriers, are enablers. But I think we should also add here the ESG or the EU taxonomy regulations as enablers. So we talk about product pricing methods for affordable insurance. I would like to go into an example of risk reduction, an example of those risk reduction incentivizing pricing, which would be the incorporation of risk reduction effects of climate adaptation measures into the insurance product pricing procedure. So that would mean if you know that there is an adaptation measure that reduces the risk, you could say that insure the client for less risk, and therefore reduce the price. And it is possible, as the adaptation measure is financially implementing it is financially feasible if it's not too high, and it will have a premium reduction. So it stimulates the implementation of risk reduction measures, and it increases overall insurance capacity. It increases insurance affordability and insurability in general, but that's risk reduction in general. For example, the Build Back Better programs for houses in flood risk, or implementing hard glass in greenhouses for the hail risk. Barriers here are the complexity of the risk or assets. So if there are too many potential measures that can be implemented, and that there's not really clear how these measures are actually going to reduce the risk, it's difficult to implement this or to actually reduce the premium. The insurance companies really need some very clear data for that. And then one of the barriers is as well financing. Who is financing these adaptation measures? If it's very expensive, then it's still a question. How will that be? It's still a big barrier to implement. So enablers are a clear risk reduction effect, and availability of technological or technical expertise and products to implement measures. For example, if the risk reduction measure is not, if there is nothing on the market, then it's also not possible to implement. And then I would like to go into look at what are the barriers in different regions, or what are the barriers that are all that are experienced in regions, and list them in a kind of categorize them kind of decision tree, kind of guidance concept, because then once you know which are barriers for example insurance supply, lack of insurance supply, this is not just a part of this tree that we've set up. And if you can identify the barriers, you can. So the green, the dark green parts here are the barriers, and then the white boxes are solutions that can address these barriers. But then some solutions have a barrier of their own, which have to be addressed then with other solutions. And I think I hope that this would enable different regions, the users of our results, to better define, how can they address their own problems, their own result challenges. So I used a lot of. We are taking into account our previous work from D3.1 and D3.2 as well, the milestones 10 and 11, work from Alexander Sushenko from the USZ, input, of course, from our case study partners. Also, Soteria partners and case study leads have also provided input, finalized in milestone 12 and all together in deliverable 3.7. Feel free to ask questions if you have some, or give comments or suggestions.